why don't we get started? Looks like we still have people trickling in. I'm not sure if I'm going to be competing with the Dodger game here tonight, actually an early afternoon game. We're probably going to go for about an hour. Oh, let me back up. Hi, my name is John Vance, president of Vance Wealth. Today, we are going to discuss inflation, debt, and the future of our economy. So pretty lively conversation in terms of just a lot of the things that are happening in the news. So I'm happy to share. It's kind of hot off the presses. So I think we're going to go about an hour, but I do have a lot of slides and I try to narrow it down. So I hope you guys will enjoy that. So I'm going to share my screen right now and then we'll jump right in. So in a couple of things, just from a housekeeping perspective, just like always, you will have the opportunity to do Q&A. And what I would suggest is as we're going through the presentation, go ahead and use the Q&A button, and then go ahead and submit your comments. And I'll go through those towards the end. And if there's anything that I want to make sure we spend a little time on, hold on here, I need to start the presentation. Then we'll obviously cover that in at the end of the presentation. So, all right. So let me just get everything situated here. Okay, so real quick, let's see here. This is on. So just quick disclosures here. I'm not going to read through all this, but Vance Wealth is a registered investment advisor. So it's really important just to know the views are that of Vance Wealth and John Vance. So I hope you enjoy. So inflation. So we're going to cover a couple economic issues being inflation and debt, and then we're going to go into kind of the current status of the economy, the future, meaning what are we seeing in the near term horizon? Knowing we don't have a crystal ball, but kind of sharing with you what's happening from an economic perspective and a market perspective. So we're first going to go into inflation. I believe I did a dedicated inflation workshop earlier this year and went through inflation 101. So today we're not going to go through all the basics, but I want to really cover what you're seeing in the media and what this really means to us as investors, as consumers. And so we're going to spend a little time here to start. So the obvious headline is that inflation is surging. So if you look at this chart, this goes back to 2000. So it really looks at just over 20 years. And on the left-hand side, you can see basically this represents yearly changes in the consumer price index. And the consumer price index is what we use to measure inflation rates. Really, the consumer price index is made up of goods and services that we consume. So this represents, so you can see kind of the yearly changes in the consumer price index. It's obviously not flat. Prices do fluctuate over time. And you can see where we are on the far right. We've had this spike north of 5%. Well, for any of you that are retired, you now know your Social Security payments are going to rise by just over 5%. I can't remember if it was 5.2 or 5.8, but you're going to see a bump in your Social Security checks as we go into 2022. So that is a good thing. So that's definitely a positive because you're going to get a larger check. But you can see here, it's not normal for us to be up at this level. You can see at the very end, it's kind of starting to come back down a little bit, and that is the expectation that inflation will start to subside, that this kind of spike is really going to be the peak. We'll find out as we get more data, but that's what it seems to us, is that it's surging, but it's going to kind of more normalize. And I'll share with you why I think that's happening. So what's really causing inflation? There's so many different factors. I do think that one of the big questions is this temporary? And the short answer is no one knows. Because we don't know, we can now just kind of project or predict. But I do think it is temporary, but temporary meaning I think we're going to see these higher level inflations for the next year to 2 years, that it's not permanent for the next 5 to 10 years. So the big factors of what's driving that: printing money, right? The Federal Reserve balance sheet's expanding, so they're printing money. Historically low interest rates. So when you have historically low interest rates, that's resulted in record high for stock prices, record high for real estate prices. People are cashing money out of their home equity, which is fueling more purchasing. Investors are seeking higher return on their capital. So they're going to find risk assets. People are tired of having their money sit in the banks. So that's causing more investment, which is causing the economy to grow and rebound. COVID-related issues are obviously a big one. Supply chain disruptions. I mean, we see right now what's happening in like the port of LA, where we have all these tankers offshore that can't get their goods in, right? So we have massive supply chain disruptions, and that's not going away anytime soon. We do have a big issue with lack of available labor due to COVID fears and enhanced unemployment benefits. And so one of the things that also is not factored into this, we have an aging population, and baby boomers are hitting retirement age, in record numbers every day. So that's another factor as well. We have just people who are saying, you know what, I don't want to go back to work. I don't want to go back into the work environment. So that's why we're also seeing labor disruption. Massive stimulus efforts. We put several $1 trillion into the economy, and we're now, our government is talking about many more trillion that are going to be put back into the economy. So the massive stimulus efforts in the past were more direct checks to individuals and businesses. And now we're seeing more of some of this infrastructure spending that is, still kind of held up, but that's what that looks like is going to happen. And obviously the future spending is not driving current inflation, but these factors are. And the fourth note that I have on here is, DC wants inflation, because at the end of the day, inflation just simply is rising prices, right? So if prices go up, generally tax revenues follow. And so if you're a government that's continuing to spend more and more money, some higher levels of inflation, moderate inflation creates additional tax revenue. So, we do believe that it's the goal of the Fed to create a little bit more inflation. It's the goal of our policymakers to create a little bit more inflation, and they're succeeding. Now there are factors, but so this is kind of a brief summary. There are always outliers. There's always other items that are creating this, but these are the main drivers of that. So this is a little bit of a noisy chart, but it kind of goes through like what happened during COVID, right? So you kind of think about these 4 elements that really kind of unfolded during COVID. And if we look at the far left, we're going to kind of go down the list. Number one thing that happened, people were quarantined or they had to self-isolate, right? So basically consumer and business demand collapsed. Businesses were delaying projects. Well, that has been resolved, right? The reopening trade is happening. People, there's still obviously some issues, but we're not seeing the quarantine. We're not seeing the shutdowns at the state level. So that's been resolved. The middle one is dealing with reduced labor supply from illness, childcare, concerns over health, lack of goods coming in from overseas, right? So this is what we call supply side, or the supply effects. This has not been resolved. This is still here and will likely be here for the next year, and we'll see beyond that. The third column here on the right now is financial market risk aversion, right? People were freaking out 18 months ago. Equity markets were getting hammered. The debt markets weren't doing well. We had massive disruptions in the financial system. People were demanding cash just to keep their businesses going, right? So that had a massive financial market effect. But now what have we seen? Markets have rallied. Markets have recovered. So that has been resolved. And then the fourth item on here is reduced trade, travel, and tourism. Now, travel and tourism is certainly not where it once was, but that has essentially been resolved as travel has resumed, vacations have resumed. So hopefully that gives you like kind of a nice a picture of really the 4 effects of COVID. One of the things that's pretty remarkable, and this is happening, I don't think as a business we're having challenges finding new hires. I think we're in a little bit different market, but the labor market is really tight right now. And this chart shows the share of small businesses that are unable to fill open positions, right? And the lack of open position, being able to fill an open position is, sometimes just matching up the right person with culture. A lot of times, especially in today, is matching up the right person with the skill set that's needed to actually do the job. So look at this chart. This has been a trend that's been going on since 2010, where a small number of businesses that was down as low as 10%, and now it's north of 50%. So that's not great if you're running a business, right? If you're trying to grow and you can't find people to work, that's a problem. But the other thing that's happening, which you got to pay attention to what headline you're reading. By having a tight labor market, that means workers can actually demand more in pay, which is actually healthy for the economy, right? So I know there's always a lot of chatter about raising minimum wage and doing some of these things, but a tight labor market kind of fixes that, right? Because if companies need labor, they have to be more competitive. They have to offer better benefits and health and 401k. They have to pay a little bit better. They have to have a better working environment. And so this is not necessarily a bad thing, but this ultra tight labor market will create wage inflation, which again, I don't think is too bad. because there's a lot of deflationary factors in the economy right now. And we'll spend a little bit more time towards the end talking about the deflationary environment that I do believe we're going to be in over the next 5 to 10 years. So these are the headlines. This was just a sampling of Wall Street Journal headlines in October. Now, this is just 4 headlines. And one of the things you got to be careful if you're looking at headlines that are coming out of the nightly news, that are coming from a daily reading, podcast, whatever you're getting your information from, media has to sell, right? They have to sell their headlines. They have to sell usually bad news, sometimes good news, but usually bad news. So look at all these articles. So IMF cuts growth forecast, warns on inflation. Inflation sets off alarms worldwide. Growth, inflation worries hit stocks, excuse me. Then the last one, inflation isn't always bad. So these are all the inflationary worries that we're getting bombarded with. And this was just a small sampling. I probably could have provided about 100 on this just from October alone. So this is something that's being hammered into the consumer, to us Americans, where we're starting to get fearful of inflation. And while, again, there are some concerns in the near term, we don't believe this is going to persist longer term. So there's a lot going on here, but let's talk about inflation breakdown. And I'm going to see here if I have my cursor on the screen. So what I want to go through is on the left-hand side, it shows what each of these percentages mean. So you can see it looks like it's an orange / reddish box. It says weighting of the category in the index. So what we're trying to look at is what drives inflation? What are the components of the consumer price index and what drives inflation? So the CPI over the last 12 months was up 5.3%, which again is way higher than normal. So if you look at what the weighting of these different categories, you can see, so if we look across the middle, we can see housing, we can see food, medical care, transportation, education, apparel, recreation, and other, right? And if you look at the numbers above, it shows you what impact they make on the consumer price index. So housing makes up 41% of the CPI. Food makes up 14.9, medical care 8.6, transportation 17%, education 6.5, apparel 2.6, recreation 5.7, and 3.1% other. So obviously a big component of this is housing, food, medical, and transportation, right? So that's a big driver. And then you can look at these broad category changes, right? Housing up, food up, medical care up. I mean, everything across the board. Transportation is a big one, primarily because the cost of vehicles are going up. Also, oil prices are going higher, right? So you can see how all of these things get affected. And then you can see like some of these individual specific categories down at the bottom. I thought it was more interesting. You can see some of these high inflationary items like lodging away from home up 17%, car and truck rental up 52%. So there's just some interesting things down here, but I want to spend a little bit of time up here at the top looking at these categories. So when we look at inflation, we are always, the headline inflation number is how it impacts our economy as a whole, but every individual is different. I'm going to go through one example. I'm just going to go through me in terms of what I'm experiencing from an inflationary perspective. And I'll tell you, I'm experiencing very little inflation, but I think I'm lucky because I'm kind of in this middle-aged stage at 46 years old where some of these things just don't factor in. So we talk about housing. So I bought my home 8 years ago. I have a really good interest rate. So my housing costs are not going up, right? So this definitely isn't 41% of what I consume. So what's challenging though is that younger generation, those in their 20s and 30s that haven't purchased a home, right? So they're kind of out of that market. Their rents are going up and the home prices are going up. But for me, I'm not seeing any inflationary pressure there. Food, definitely, with a growing family, we definitely have really high food costs. So that is impacting our household. Medical care, not so much, right? We have young kids, or I guess not so young anymore, but we have a lot of teenagers, and then I don't consume much medical care either. So we don't have real medical care issues. Our medical premiums are going up, but we're not consuming a lot of medical. Transportation. I drive a Tesla. I have 50 solar panels on my house. So I actually got lucky. Before all this hit, we had 2 cars for our teenage drivers. So we're not seeing this raise in transportation costs. And also with not traveling anywhere and everything's local, we're not seeing the gas prices really impact our family either. So, and then education. Education is obviously a big one with kids going into college. But we started planning, when my kids were 1 year old, to save. And so hasn't really become an issue, even though, because we were anticipating these educational costs. And I realize I'm lucky in that. I do feel very fortunate. But one of the things you got to realize with inflation is it hits everyone different. How it affects young people, how it affects retirees. Most retirees who have their home paid off, housing is not much of an issue. They're dealing more with food and medical. The flip side, on the other side, recreation. Has anyone flown recently? Airline prices are way down. So, there is some deflationary impacts in there. So hopefully you appreciated just kind of sharing my perspective on there. Inflation is an issue in many different industries, but you have to think about how is that impacting you individually. And it is real, but I'm going to go through why I don't think it's going to persist. This is also just to give you some perspective. It was kind of fun. It's always kind of fun going back in time. So a dollar goes a lot further today than any other time in our history. So what we're looking at here is basically three pie charts. And these pie charts show the 1900s, 1950, and 2019. And it shows that things like clothing, look at the 1900s, 14% of your income was spent on clothing, 43% on food, 23% on housing, and 20% on other. And that was 102% of your income. Look at currently, expenses are 78% of your income. So you actually have money you can save. And look at what you're spending on clothing at 3%, food at 13%, housing at 33%. So that has grown, and other is 51%. Things like leisure, entertainment, that didn't exist back in 1900. So these are all new phenomena. So even though we do see inflationary pressures because of how what we're consuming, there's been a lot of deflation, and obviously our country's a lot wealthier today than it was 120 years ago. So hopefully this gives you a little bit of perspective. So that's my story on inflation. And this is just the last thing that I want to end on. If you have a lot of debt, meaning, and I mean good debt, right? So investment debt, like a home, inflation is your friend. So many of you who are clients, I've given this example probably live to you. I'm going to give you a real simple example here. So if you're a homeowner and you are taking out a brand new mortgage, $1 million mortgage, and your current interest rates on a 30-year fixed is 3.5%. Well, at 3.5%, your monthly payment is going to be roughly $4,500 a month. So one of the things that's beautiful about having inflation in the system, what happens? Your wages increase over time. Your wages increase because of two reasons. You're better at what you do, and there's just general inflation. So that means you're going to get a bump in how you get paid over time. So the assumptions that I made in this analysis is that your mortgage payment when you start out is 25% of your gross income, right? So when you buy that house, that mortgage payment is 25% of your gross income. So then you can see what I assumed your monthly gross income was to afford $1 million house. And let's just assume your gross income grows by 5% annually. So in 20 years, your income is going to be substantially higher and your mortgage is locked in at $4,500, assuming you stay in the house and don't refi. And that means instead of being at 25% of your gross income, it's now only 9% of your gross income. And in 30 years, at the time you're paying it off, that last payment only represents 5.8% of your gross income. So this really is the power of home ownership. It's also why I don't recommend people go out there and try to pay off their mortgage so quickly, because you get the benefit of making future payments with inflated dollars. And that's what's so powerful about it. You get to borrow today and pay it back with inflated dollars. So, and frankly, that's why we believe that the US government is trying to create some inflation, is because they are the largest debtor in the world. And so when you're the biggest debtor in the world, what do you want to do? You want to create inflation because that means tax rates go up. So it makes servicing your debt easier. So here we go. Now, one thing as we wrap up, I do have some questions. I'm going to go check because they're probably inflation related. But one thing I want to caution you, we've been in a world where inflation's been running between 1% to 2% for the last 15 to 20 years. Right now, we're running at 5%, which I think is abnormally high. I do think we're going to settle into an inflationary environment that's higher than it has been the last 20 years. So instead of 1% to 2.5%, I think we're going to be looking at closer to 2.5% to 4%. So I think when I talk about inflation, we're going to have some elevated inflation, but I don't believe we're going to have hyperinflation, things that happened like in the 70s. And I think that's where a lot of investors are getting a bit worried. So let me just do a quick check-in here real quick to see if there's some things from an inflationary inflation questions that I want to address. Uh-oh, it's not letting me open my Q&A here. All right, I can't get into my Q&A, so I'm going to just do that here at the end. I don't know why that is. Okay, so this first picture is the not so pretty one. So federal debt has ballooned over the past 2 decades. So if you look back around 2000, the last time we had, when Clinton was leaving office, we had an economic boom in the late 90s. We ran a balanced budget. We had a surplus, actually. Our debt at the time was $5 trillion. We're now quickly approaching 30 trillion. So in the time of George Washington, the founding of our country, all the way to 2000, we took on $5 trillion of debt. We're now close to accumulating 25 additional trillion dollars over the last 20 years. So pretty remarkable. This is not a surprise to anyone, but that's obviously creating some concern for Americans, for consumers, for investors. Like, what does this actually mean? So just want to run through a couple things. So we're going to look at 2 charts here when it comes to debt. Number one being consumer finances, and then we're going to look at government finances. And so there's a lot of noise going on here, but hopefully it's okay to see. The first column here on the left says assets. So when you look at assets, as our consumer balance sheet, we have around $160 trillion of assets, from homes and other tangibles, deposits in banks, pension funds, other financial assets. This is the consumer balance sheet. And then you look at the debt. We have $17 trillion in debt. So look at how healthy that is, right? We're looking at an environment where we have 160 trillion in assets and 17 trillion, or almost 18 trillion in liabilities. So it's pretty remarkable how healthy we are. In the top right corner, it shows household. Oh, my picture is right over it. So it says household debt service ratio. So because interest rates are so low, even though individuals have more debt maybe on their home or on their car, the debt service payments have gone down because incomes have gone up and interest rates are super low. So look at how healthy the consumer is, right? Our debt service payment as a percentage of our income is at lows that we haven't seen in over 40 years. And then you can see the household net worth, right? Net worth is what drives a lot of our spending habits, right? As people have more money, feel wealthier, they feel freer to spend money. And so the fact that we're hitting all-time highs in net worth means the consumer side of the equation is quite healthy. And don't forget, we had a ton of stimulus that got put into the system, and that's helped most consumers as well. So the not so pretty picture is, oh, it looks like my thing ran out of batteries. All right. So the not so pretty picture are the federal finances, and this is no surprise. So if you actually look at this, this is just we're gonna go through what the annual federal budget is designed to look like for next year. So the spending tally right now is around $5.5 trillion. So that's the forecast. And you can see kind of the categories that we go into. I'm going to start from the bottom. So Medicare and Medicaid make up 26% of our spending. Social Security makes up 22% of our spending. So right now we're at a point where 50% of our spending just goes to Social Security and Medicare. Then you can see defense spending at 14%. Non-defense discretionary spending is 16%. Net interest. So even though we owe almost $30 trillion, our net interest expense is still only 6% of our budget, which is why politicians really haven't had to make a tough decision around spending, is because our net interest expense is really low and our economy is growing. And then you can see others. So all the rest of the federal programs get lumped into the other. And then you can look on the right-hand side, sources of financing. So where does the money come from? Personal income taxes is at the bottom, then corporate taxes, then social insurance, right? That's payroll tax. That's what you're paying tax on for Medicare and for Social Security coming out of your wages. And then you can look at the borrowing number. So right now, as it's being forecasted, is that 21% of our spending is just going to be coming through borrowing. So that's adding another $1 trillion. And that's not factoring in some of this additional stimulus, right? This is just our baseline spend. So that's the not so pretty picture. Now, one of the things that I've had just debates with just people, clients, friends, like, well, when is this going to matter? And the short answer is I don't know. I mean, I remember I feel like it was in, a history class back when I was in like 7th or 8th grade, and we were talking about that it mattered. And this was back in the 80s. Is like, the debt is out of control. And this is when we only had a few trillion. The debt's out of control. It's not good for our economy. Well, now we're so many multiples higher, and our economy is the best in the world. It's the strongest in the world. Our companies are the most innovative in the world. So it's hard to fathom, like, when is this really going to matter? And the one chart on here that I think if you read kind of classic economics around the economy, this bottom right chart is what I think gets the average economist pretty nervous, right? So this bottom right chart basically represents net debt, so basically accumulated debt, as a percentage of the economy. So if you look at where we are today and where the previous peak, that previous peak, if you see at the very bottom, it starts in 1940. So that previous peak was all that spending leading up to the end of World War II, right? All the spending that had to come into place, and all the spending that we had to start putting back into place to rebuild and to just, to start to, get our economy back on track. And then if you look, our debt went down dramatically through the 70s and 80s, and then you can see it's been on the rise since. And so we're kind of back at these similar levels. And so right now we're at 100%. So meaning our debt is 100% of our GDP, and our net debt is 100% of our GDP. And that's where you start getting into problems, when you start getting above 100%, because it becomes almost impossible to service that debt. So I don't really have good news on here, other than the fact that we're going to continue to run a debt. This is kind of classic economics that we've been dealing with over the last 50 years, is kind of ignoring these factors. And, and I know that makes a lot of people nervous, but, I don't really have an answer for how we're going to stop this. Neither political party has an appetite to really cut spending. So until we start really being disciplined about spending, this is going to continue to persist. The good news is we have innovative companies that are not the federal government. We have consumers that are building wealth. And so we got to remember how we got to separate those two things. All right. And I think I showed this chart earlier, but basically what this represents, I like this chart because it kind of goes back in history. It's not a super long period of time. It goes back to 1985. And what this chart basically shows is basically, if we look at the percentage of GDP that we either collect in revenue, meaning taxes, or we spend. And so if you look on the far left, it shows percentages, and you can see where the first lines begin is somewhere between 15 and 20%. So where you have revenues of just north of 15%, which is the blue line, spending, which is just north of 20%. And you can see as we kind of made our way through this period of time and we got to 2000, guess what happened? We had a surplus here, right here in the middle. And that's when, revenues were continuing to rise, excuse me, and spending went down. Well, you can see we've had maybe a little bit more discipline then, but, over the last kind of post 9/11, we saw obviously spending increase dramatically and revenues have come down. So that's obviously been problematic. So a big part of how we need to get this fixed is that, revenues do need to come up, but it's interesting, right? If you look at this chart, they're kind of historically right around this 18% line. So the challenge is we have this big disconnect. So is it, are we going to be able to get our revenues up to 22, 24%? It's probably going to be difficult. Sorry, just need a little water there. So this is something that, again, in my humble opinion, we're going to need to tackle this from both sides, not just tax issues. It's going to be needing to be some spending reform to get this back into alignment. But like I said, no political party has any real desire to do that at this time. So one of the things obviously we're dealing with right now is the change in the tax code, and specifically the change in the tax code that's likely going to be put in place. Not sure if it's going to be done by year end or if it's going to be put in place for next year, is this whole conversation around, do the rich pay their fair share? And when you look at the data here, it depends on how you define fair share, right? So what we're looking at here is share of all the income earned. So the bottom 50% only earns 12% of all the income, and then they pay 3% of the taxes. The top 1% earns 21% of the income, and they pay 40% of the taxes. So depends on how you define fair share, but you can see here, obviously, this is more heavily weighted to the top the top 10. And that's what this new tax code is designed to do, is really go after those, single tax filers above 400,000, married filing jointly over 450,000. So with this chart, I guess I would make the argument that, do they pay their fair share? It seems like this is what's called a progressive tax code, right? Meaning the higher earners pay a higher percentage of the overall income taxes paid. So that is what our tax code is designed to do. What is pretty fascinating, I read an article in the Wall Street Journal around, well, what's the rest of the world look like? So I apologize, this is a little bit blurry, but this came out of the Wall Street Journal, and the source is the Organization for Economic Cooperation and Development. And what this basically looked at, because a lot of times people kind of say, we wish the US had more of the Canadian model or more of the European model. Not all, and certainly not everyone, but many people will state that. And so one of the things that I found interesting here is that what happens in France, Germany, and Sweden, and in most European countries, is that look at the percentage of what the top 10 taxpayers in terms of the percentage of taxes paid. So what we're looking at here is this chart is showing that the black up top shows what the top 10% of taxpayers pay in terms of all taxes. So you can see in the US, the top 10% pay the lion's share. This dotted line represents what the US tax, the top 10% pay, not quite 50%, but almost. And then if you look in France, Germany, and Sweden, that number is more like 25%. So my only message on this is that in order for us, if we're going to keep up with our spending needs of our government, we're going to have to make some decisions. Either we're going to raise taxes on everyone, and that's across the board because we're going to need to get more participation of everyone, or we're going to got to bring back spending and keep tax policy where it is, right? And I know many of you listening, support one way or the other, and that's okay. But that's the reality, is that there's unfortunately not enough of the top 10% to actually generate enough revenue for our current spend. I did put a little note over here. This was from an op-ed in the journal. And it was kind of interesting. Warren Buffett talks a lot about how he pays a lower tax rate than like his secretary, right? And you got to be careful with some of those numbers, but it's kind of clever. If you read the note here on the side, so basically the bottom quintile, meaning 25%, pays 7.5% of their income in taxes. The next quintile is at 14% of their income in taxes. The middle is at 22. Oh, I'm sorry. We're doing the top 20%, excuse me, or the bottom 20%. The fourth quintile paid 28%, and the top quintile is at 35%, right? So, but it continues to rise basically to 41% on average before dipping to 32% for the top 400 income earners who earn more than 400 million per year. So one of the disconnects with our tax code is that the top wage earners do pay at a higher rate. You can see that tax burden is around 35 to 41% of all their income earned is paid in tax. But it's the top 400 earners in America that earn more than 400 million a year that actually pay far more in taxes, but at a lower percentage. And I think that's a lot of the argument of why the Democratic Party is trying to put in like a wealth tax to try to balance this off, right? So that's the interesting dynamic. Is I think the top 1% and the top 10% are really the targets because they're the highest earners, but it's really this top 400 that are the kind of the major tax, the major earners that are being taxed at a lower percentage, still a higher dollar amount. So just thought I would share that with you because I just found it to be interesting. Just kind of some interesting data when we're looking at that. So the debt issue, in my opinion, is going to be resolved by spending discipline, and that's not going to happen. Hasn't happened in my lifetime. It hasn't happened in any of your lifetime. So I don't see that being fixed. The good news is we have the private sector that innovates. Okay. So the future of our economy. So I'm going to run through some charts on here. I'm not going to cover every piece of that just from a time perspective, but I do like sharing visuals because it just kind of helps paint the picture. But one of the things we look at, if we just reflect over the last 18 months, is this idea that the best views come after the hardest climbs. So if you think about when we started into the beginning of COVID and the economy was in a free fall as the economy basically locked down and states locked down, we went into this really quick recession, right? So where the markets we went into a recession like this, like right overnight. And if you look here on this first chart, it shows the worst quarter of GDP growth on record, which basically, if you go back, this is data going back 70 years that are basically our economy shrunk by 31% in a quarter because of the lockdowns. And if you look at the headlines on the right-hand side, US 46 states implemented stay-at-home orders. You can see the consumer confidence index fell by 33 points, which is the largest monthly decline on record, and 20 million jobs were lost in April. More than 10 times the record set back in 1945, right? So it was a dismal period of time. And, the government stepped in and provided this short-term stimulus that really kind of kept things afloat. and got us to crawl, I guess, bounce off this bottom. And so then when you say, okay, this was really the view from the bottom, is all this bad news. And then we go into the next piece, and then we look at, okay, now the recovery is beginning. And look, we had the shortest recession on record. So this is a chart that shows going back to, I think the latest date on here is, well, I have a 1860 date. So in 1860 and 1918 and 1945, and you can look at, these were all some of the shortest recessions. All these short recessions were 6 to 8 months. And this recession was 2 months. And again, that was because of, I believe, the quick response by the government to stabilize things so we didn't have a panic. And then you say, okay, now that we're coming out of this short recession, now what do things look like? And so you can see this top chart, how quickly the economy recovered, and now we're hitting all-time highs. And if you look at the bottom chart, shows corporate earnings levels that are above pre-COVID levels, meaning corporations are more profitable today than they were at the start of COVID, right? So that shows you how things recovered. And this is, now we're back at the top saying, okay, wow, that was a kind of a crazy run, but now we're doing well. Look at these headlines. $2 trillion in excess disposable income was realized due to fiscal stimulus. That's how much money was injected. And if you look at a lot of the stats, most, as a whole, Americans came out of this with less debt because the stimulus put them in a really healthy position. Year over change in household net worth reached a record 23% in March. And then, 95%, the best start to a bull market in history. So if you think about what's happened since the bottom, since when COVID began and the bottom that was hit, the markets are up 95% from there. Now, if you're measuring from the previous peak, it's not 95%, but that's how quickly things came back. And it's remarkable that's been the kind of in the rear view mirror, those 18 months, which were, obviously historical and unprecedented. And one of the things that, from an economic perspective, some of you may not like this, but this seems to me like the federal government and our politicians, with the assistance of the Federal Reserve, has a new playbook. And that playbook is, if we have economic pain, we're going to stimulate the economy, because we don't want to create pain for our citizens. We don't want to create pains for consumer. We also know that to keep our economic engine going, we need our businesses to continue to move forward. We need people to keep working. And so that seems to be what the playbook's going to be, is when we go into slowdowns, the government's going to step in to stimulate. Now, I studied economics in college. There's all kinds of hazards with doing that, because people will take undue risk. But with that being said, look at the history of America and look at the fact that these blue lines represent the average length of expansionary times. And then the dark gray represents the average length of recessions. So we're looking at basically 3 50-year periods and then 2000 to present, which is only a 20-year period. But from 1850 to 1899, look at what happened. Expansions and recessions kind of mirrored each other. And then from 1900 to 1949, expansions got a little bit longer, recessions kind of got a little bit less. 1950 to 1999, look at the difference there. Now expansions were lasting 60 months or 5 years, and recessions were even less. And look at this last 20 plus years, our expansionary periods are now lasting 100 months, close to 10 years, and the recessionary environments are kind of the same. So that seems to be the playbook, is moving the economy forward. But by doing so, you got to take on more debt. You got to increase stimulus. You got to print money, things that technically are unpopular. And I guess in the classic economic literature would say you shouldn't do for a long period of time, but this playbook seems to be working for us. Again, I do think we need to have a little bit more discipline around it, but this seems like this is going to be the playbook for how the government and the Federal Reserve manage the economy on a go-forward basis. All right, so we're going to jump into just some quick items here. This was some data that I got from Raymond James that I found to be interesting. So basically, the Federal Reserve is forecasting, a kind of a pretty landscape, that the economy is growing, and it's not growing too fast. So we have 3 charts here. I'm going to go from left to right. The GDP, which is gross domestic product, which measures the growth of our economy. And so you can see here the first bar chart is 2021, which is where we are today, which is about 5.9%. And then next year projecting around 3.8%, and then the following year 2.5%. So we're declining, but that's normal. The economy of our size, it's really healthy to grow at the 3 to 4% level. So next year looks like it's still going to be a strong growth year. Unemployment forecast, which is the middle chart, right now we're at about 4.8%. It's forecasting to go down even lower, 3.8 and 3.5 in future years. Again, that should be great for wage inflation, meaning workers being able to demand more wages. Because think about it, when there's less of a pool out there, less people looking for work, the way companies differentiate themselves, they have to pay more. And for a strong, budding, growing middle class, they have to earn more money to keep our economy moving forward and participate in the growth of, in the growth of our economy. And then the last one here, hotter inflation, but likely to moderate. So you can see our inflationary numbers for the year for 2021, about 3.7%, and then next year 2.3. I actually don't share those numbers. I think they're going to be a little bit higher than what the Fed is predicting, but nonetheless, that's what the Fed is thinking is going to happen. So these are all good signs and healthy signs for the economy. So there's a lot on here. You've probably heard the term climbing a wall of worry. Generally, that's a very healthy expression when you're looking at financial markets, right? When you're looking at the stock market, when you're looking at the real estate market, when there's worry out there, that usually means it's still a good time to invest. When the worries go away and it's all optimistic, that's generally the time you want to be concerned. And so when you start looking at what are all the worries that we're seeing, and we start looking at, well, what's one of the worries? Elevated equity valuations, right? Meaning stock prices are too high. So from a historical perspective, they are a little rich. However, when you compare them to what you're going to get in a bank account or in a bond, the valuations look okay. Peak earnings growth, right? We're seeing earnings numbers hit these peak levels, especially coming off COVID. And so that's going to start to slow, but earnings numbers are still really good. Companies continue to beat their earnings expectations because they have pricing power. You probably noticed companies are raising their prices. They have that ability. One of the concerns is slowing GDP growth. Well, remember, we're going to be slowing from this high level, but it's kind of normalizing back into our normal trend of that 3 to 4% range. Fed tightening, so Federal Reserve tightening, basically meaning raising interest rates. So you're seeing a lot more chatter about the Federal Reserve, basically, have them stop purchasing assets, which is keeping interest rates low. I think that should happen. Our economy is stronger than most people are giving it credit for. And I think the Fed actually should let interest rates come back up a little bit, or at least stop artificially keeping rates down, especially on mortgages. The housing market does not need more help. We don't need rates as low. It doesn't need more help. The housing market is booming. So the Fed tightening is a worry. Income and corporate tax hikes, right? That's something we've talked about in previous webinars, that tax rates are going to go up. It depends if you're concerned or not, if you're going to be that group of individuals that will be taxed at a higher rate. So some of the changes on the corporate tax structure, they're not so punitive that it's going to disrupt this rally. In my opinion, we're not even going back to levels kind of pre-Trump. We're going back to kind of halfway in between, which is what they look like they're settling on. So I think it's more headline risk rather than actual risk. Rising interest rates. We've been all hearing about rising interest rates for the last 5 to 10 years. Our humble opinion is that rates are going to stay low, maybe not zero, but low for the foreseeable future, primarily because the largest borrower in the world, the US government, owes $30 trillion. And when you owe that much, you can't really afford to have interest rates go up too much. So we do think that rising rates we're going to see rates rise slightly, but not to the degree where people should be freaking out. So that's kind of the wall of worry story. And then we start looking at this equity bull market. So, it depends how you look at it. Bull markets, when a bull market ends when you have a 20% correction, and then technically you go into a bear market. That's what it is. That's a technical definition. And these bull markets tend to last 6 years on average. So we're arguably 1.5 years into this new bull market. So we still have more time to grow. And if you look here, so we believe we're still in the early innings of this bull market. We've had the best start essentially ever. And then we're going into a seasonally strong time for the markets. And so I know people are concerned because we keep hitting these all-time highs and they're wondering, when's this going to come down? And because of all the stimulus that we're seeing and the strength and the health of our economy, we don't see any sort of permanent decline in the near term. We're going to see volatility. That's normal. That's stuff we are all used to, but not any, we're going to be actively buying into any weakness versus selling into that. And so that's something that we'll be putting in place for our clients to make sure we have that discipline. Okay, so I'm going to end this idea of, so we spent time on inflation and debt. So hopefully the summary you got out of inflation is that modest inflation is healthy for the economy. Running at 5% is not a good thing. We are going to probably normalize back into like a 2.5 to 3.5% range. And so there are going to be some inflationary pressures, especially how the Federal Reserve measures it from a CPI perspective. We do think it's going to be transitory, which means temporary. And the reason why is because of this slide: better, cheaper, faster. If you think about what the world is starting to look like, is this idea of better, cheaper, and faster. And if we start unpacking industries like technology, phones, cars, all the things that we consume from a consumer electronic perspective, they're better, they're cheaper, and they're faster for what you're getting. And then you start extrapolating that into medical service, things like telemedicine. When you start looking into the banking sector, some of you have heard me say this is, when you start talking about inflation versus deflation or deflationary pressures, think of the impact that's going to happen in the banking world. Most young people and even most consumers now are doing banking on their phone, not using a lot of cash, using things like Venmo to live their daily lives, right? So the need for a physical branch, I think there's something like 85,000 branches around the country. Well, in the next few years, those are going to close down. So, sorry, need a little bit more water. Those are likely going to close down. Think how impactful that is for a bank's earnings if they don't have to run all these facilities. They don't have to staff them, and they don't have to pay for the real estate. So better, cheaper, faster. That's going to be really the theme that you're going to see that's going to persist in kind of the innovation that we're seeing in the world. So I think I led off this past year with this idea that we're probably in this period of the Roaring 20s. The leading tech of the 1920s were the refrigerator, the vacuum, the radio, and the sewing machine. And the leading technology of the 2020s is artificial intelligence, gene editing, 5G, digital currencies, 3D printing, and that we're in this period of boom, and people are I believe underestimating the power that this is going to have on the economy. The other thing that I didn't mention, COVID is going to now force hybrid work environments, and so hybrid working is going to be highly deflationary to our economy, just because of the dynamics of people not needing to commute, businesses not needing full-time real estate to house their employees, and software is going to continue to develop to make that better. So we really believe that you should be looking at this decade as really the next Roaring 20s. So a couple of things I just want to focus on, because sometimes I get way into the numbers, and it's like this idea of like, let's remember the progress we've made over the last 100 years, and that the human condition continues to improve. So US farming back in 1850, 40% of workers were in farming. In 1850, 50% of workers were in US manufacturing. Now what's happened is 1% of our working population does farming, 11% in manufacturing, and 87% in service jobs. Service jobs obviously more demanding on the intellect and on those job skills, and not as demanding on the body, but we have a much healthier working environment. Some of you have seen this chart before, is just remembering the improving human condition. Global poverty is disappearing. And this is not to scale. You can see here, we're starting back here in 1820. 1820, we had the entire world that was experiencing global, massive poverty. And if you look here, by let's say 1981, you can see we had a pretty big breakthrough where now half the population was in poverty, half was not. And now we fast forward and look at the progress of where we are today. We're looking at, less than 10% of the world is people living in extreme poverty. So, that is a benefit of the advances we've made, the technology that we've, continued to innovate on. And the things that I think people, I think a lot of us feel like, okay, what's it going to be like for my kids? We have this debt to pay back. We have, maybe we feel our schools aren't as good as they should be. One of the things that makes me very optimistic about the future of our globe is that we're going to start having, and this is going to be a challenge for our kids. Our kids are going to be competing with people all over the world. That hasn't really been much of an issue, unless you're outsourcing jobs all the way to, China and other places. Now with technology, these service jobs are going to be able to be outsourced. And so, it's going to require our education, our level of skill to go up, because so much of the technology now, the 5G, the smartphone, is basically improving. We are now going to have a globally educated, we're going to have an educated middle class. And it's remarkable when you look at the literacy rates that are occurring across the world, and then you look at the middle class population, across the world. And one of the reasons why we do think our stocks are going to do amazingly well is that people want our products. People want they're using the Apple and the Apple products and Microsoft products, and it's the benefit from the world getting richer, and it's driven by a lot of these factors around the globe. And so that's something that gets missed, because I think we live in the U.S., so we're focusing on a lot of the challenges we have here, and I think we're missing the big picture on how this is going to expand and actually benefit a lot of our U.S. companies, because they're going to be benefiting from this change that's happening all over the world. So megatrends that are going to define the next decade. My job's not to make you an expert in here. It's just to kind of share some of the areas where the big changes are occurring. And I mentioned a few of them as we went through this, but the technological revolution, and really that's defined by cloud technology and AI. The genomics revolution, which is really biotech, and smarter devices, smarter diagnostics. So, I mean, if you look kind of at some of the examples under here, especially in medicine, is going to be more, more targeted, more specific medicine for our specific DNA. And then the far right here is empowerment of the consumer and the brands. E-commerce. I mean, think how e-commerce has taken off. And then, all that's happening in social networking, streaming content, remote learning. There's so much disruption that's occurring. I get excited about it. I don't know how it's all going to unfold, but that's the beauty of the entrepreneurial system that we have here in America, is that because we do have a profit motive, when we invest in companies, it's to make money. It really drives this massive amount of innovation. And I know you guys might be getting tired of my optimism, but I can't help myself, and you can't change my mind. So the one thing that I think is really, shows a timeline of what's happening with this digital acceleration, and showing you what really happened because of COVID. So if you look at this, the chart says penetration of digital trends. So from e-commerce to telehealth visits, to streaming, to digital payments, to cloud computing. So you think about the breakthrough that these areas have had, but look at how much has just occurred, as of late, as of the last year. So e-commerce expanded, telehealth visits, expanded, essentially didn't even exist in 2019. Streaming expanded massively. Digital payments, look at that growth there, and cloud computing. So we're only at the infancy of this acceleration, and this is obviously going to continue with the adoption as society. And I think I've showed you guys charts in the past about just the simple things like a TV and a landline phone, and how long it took to adopt these as part of just everyone's daily life. And so this acceleration is going to continue to happen. And it's going to continue the way that we do business and how we communicate with people. And that's why I get super excited about how things are happening. So when we start focusing on debt issues, inflation issues, those are all headline risks that keep us, I think, from being good investors and just kind of being at peace with what's happening. And when we start actually looking at the big picture of where the disruption's occurring and what that means and all the good things that come out of that, it's exciting. So hopefully you enjoyed today. I know I didn't solve all of life's challenges, but hopefully that some of this insight is helpful and valuable for you. If you have any more questions you want to follow up, please let me know. I'm going to see if I can I'm going to answer some questions. I had a little bit of challenge pulling up my Q&A, so hopefully I'm going to stop sharing. Oh, here we go. That's all I had to do was stop sharing. All right, let me make sure I do these in order. Okay, so bear with me. I'm going to kind of read through. So I have a question here. In the Wall Street Journal, economists seem to opine that $3.5 trillion budget that is being discussed would be highly detrimental for our economy. If they are correct, how are we protected from this news? So I didn't read that article. So it's a good question. It's a fair question. And I think it probably was left out, budget deficit. I think the general conclusion is that adding that kind of debt is just irresponsible, right? As individuals, we wouldn't consume that kind of debt. But if you think about it in the short term, it's probably highly beneficial for the economy. From one perspective, is it creates a lot of demand, right? Because money is going into the system. But the bigger concern is we have a labor shortage, right? So, and I think this is maybe what this article spoke to, but I did not read this. But The biggest concern that I have with the size of the stimulus bill, we can argue taxes till we're blue in the face, but the problem I have with the stimulus bill is we currently have a labor shortage. We don't have enough people to do the jobs we currently have. What happens when the stimulus bill goes into effect and it creates all the spending that's desired around infrastructure and all these things that we need? Now we have the government coming in there with all of this money trying to do work. We don't have workers right now. So what are we going to do? So that's a big issue that I'm concerned with. That could perpetuate the inflation problem. So when I talk about inflationary pressures not being an issue, the government could mess that up, because if they create too much demand, right, they just print money and put it in, it'll cause inflation to be higher. So that's why I'd like to see them scale this back. We need to fix immigration, because if we can get more immigrants in here to actually do some of the work that maybe Americans don't want to do, or high skilled jobs that Americans can't do, we need to fix that issue, because if we're going to grow and we're going to keep developing, we need more workers that can do the job. And that chart that I showed, around 50% of small businesses that are looking to fill jobs cannot. That's a troubling sign. So again, I thank you for the question, but I didn't read the article. But I think that's the big concern, is that we're looking at actually creating this massive demand that might cause inflation to be a bigger problem than it is today. I have another question. This is about wages. How much has the increase in minimum wage had on inflation? You know, I don't have data to give you my answer is going to be a little bit more of how I feel, not the data, because the data studies on minimum wage on inflation there's not really any, I guess, conventional agreement around, okay, this is what this means. If you think about what's happened with minimum wage, you know, back several years ago, we had $10 minimum wage and it went up to $11, right? So that's a 10% increase. And then from 11 to 12, 12 to 13, right? So now we're at 15. So it does create some inflation. It does create costs for the employer. But I think what I would refer back to is kind of while I'm not a big fan of minimum wage rules, I do recognize that supply demand will drive that. And in a tight labor market, people can't pay minimum wage, because if you do, you're not going to attract employees, right? Because people will have different options. But I do think kind of the last part of the conversation today, where I went through and discussed kind of the innovation that's occurring, all of that stuff is so highly deflationary that I think we're going to go into an environment that workers are going to get paid more because they're going to be doing a harder job, but technology is going to make them allow them to do their job more efficiently. So hopefully that's what we're heading into, is a time where workers are getting paid more for their time, and rightfully so, but we have technology that's going to aid them to do a more effective job. So obviously that's the optimism in me looking at that. How minimum wage factors into that, you know, that's a fairly long, probably political debate that we might not come to an agreement on. But I don't have specific data on how that impacts inflation. But that's a good question. All right, so let's see here. Okay, it looks like I have a couple questions here that are all kind of tied together. So if current inflation drives prices up 10 to 20% for an extended period of time and prices level off, prices stay the same and then increase at 2 to 3%. Well, the CPI, let's see, we will say the CPI is 2 to 3%, but in reality, it's on top of a significant increase. Prices usually never drop once we get used to the spending of that level. So I think that's a good statement. So let me summarize this a little bit. The whole idea is, let's say we see a jump in prices of everything by like 10% in 2 years, right? We're seeing about 5% now. Let's say we saw another 5 on top of that. So then now all of a sudden, then we get into a more normal environment where inflation's only at 2% or 3%, but it's on top of that. So that's a very true statement. But I would argue that inflation, it depends what we're measuring, right? Because I know who's asking this question. I'm not going to share it with everybody, but you're retired. You have your house purchased, and you see the inflationary numbers was 40% based on housing. So for you, you're going to have maybe higher medical costs, maybe higher travel costs, maybe higher food costs, but there's a big part of your living that is not going to be inflationary driven. So even if the CPI goes up, you're not going to be experiencing the same inflation as the whole economy. The flip side, I guess additionally to that, the average worker, because we're seeing inflation, we're likely to continue to see wages go up. Maybe some states are going to continue to enact higher minimum wage. I know there's been some chatter of $20 an hour. So So I think it works itself out. We can't have pervasive inflation that's running at 5% a year for 10 years. That's really detrimental to the economy. But for a couple of years, I really don't think it's going to be that impactful. And one of the big reasons is that over the last 10 years, inflation's been historically low, like 1.5 to 2, maybe even 2.5. So the whole idea is if we have a couple of years of higher, we're kind of catching up. And the Fed has already stated that's what they want to do. They want inflation and growth to kind of catch up. Yeah, I see a note here. And then also with the 5% increase in Social Security benefits, it's like maybe on your full Social Security, that's like $2,000 a year. Most of that might be eaten up in gas prices alone. I mean, you're right. Depending on what you're consuming, but that's what the Social Security is designed to. That's what Social Security increases are designed to do, is supplement the income. It's not designed to give you more income. It's just designed to say, okay, inflation went up by 5. We're going to make sure we're giving you enough money to at least keep track. Not to get ahead. So then the last question here is, if the debt ceiling is not raised enough to cover federal spending, does reconciliation take place? And what exactly is this? I will have to admit, I am not an expert on the whole reconciliation process. The debt ceiling issue is just like, it's like a political hot potato, right? So we have a debt ceiling that we just keep moving up. So it's kind of a joke. But what happens is every time they have to get to make some tough decisions, one party holds it out against the other and said, well, we're not going to raise the debt ceiling unless you vote on some package or something. And so there's really this kind of hot potato that just creates a lot of stress for, I think, consumers and especially government workers. But at the end of the day, they always raise it. So the fear is they're going to not raise it and they're going to close the government down. It's like going on strike, essentially. But it never lasts that long. So we have a printing press, we have a robust economy. So I think it's more just headline risk as investors. When we see that happening, we look at it as an opportunity to go buy things at a discount. When the markets freak out, we're okay with that. But we just don't see it's a long-term issue, other than just the identifying that our political parties are not working together, and they're using the political process to create a lot of division that we all know. So the reason why I'm optimistic is not because of what's happening in Washington. It's because all the innovation that's happening across all businesses in America, and kind of the spirit of the American worker. So hopefully that was, I know I covered a lot of material. Next month, let me come back and share my screen real quick. And let me share my screen, and real quick, I have on the slide deck here in front of you. If any of you are not clients of Vance Wealth and are interested in getting some help with your financial planning, or maybe even year-end tax planning advice, we offer a 30-minute complimentary consultation. So even for clients that are on this that maybe have loved ones or friends that need some help, you can extend this to them as well. So you can just scan the QR code or go onto our website to book an appointment. And then just as a reminder, our next webinar is going to be November 16th at 4:30. So kind of same time, same place. And we're going to go through and we'll talk about year-end tax planning. And we're going to have 2 parts. So we're going to talk about personal tax planning in part 1, and then tax planning for business owners in part 2. So those of you that are both, I think you should stay on for the duration. If you're just an individual, no business, then part 1 is going to make sense. And I'm going to try to break it out into about 30-minute increments. So hopefully this was valuable. Thank you very much. Have a great night.